Hey everyone, this is Kirk here again at optionalpha.com, where we show you how to make smarter trades. And in tonight's video, I want to talk about our new opening trade that we had today for an iron condor in FXE. So it was the only trade that we had today. The markets were really active. Stocks were selling off pretty well today. A lot of the stocks that we watch, including some of the major indexes, closed pretty much at their lows on the day. So this really signals to us that the selling might continue, or at least the path of least resistance here is to the downside in most of these stocks that we're looking at. Now, with that in mind, we did enter a new position in FXE. So our FXE position was an iron condor, but it was a little bit different in the fact that we had a skewed iron condor. So we obviously know that the markets are under a little bit of pressure right now, and we don't want to set ourselves up for a really bad situation in case FXE does continue to head lower. So what we decided to do is do an iron condor, but again, a little bit different, and skew one side so that we have a little bit less risk to the downside in FXE if it does in fact continue lower. So I'll go through it here in a second, but again, the logistics of the trade are that we sold 3 iron condors in FXE. We sold the April 109, 111 call spread. You'll notice that is a $2 wide call spread on the top side. And on the bottom side, we sold a 102, 101 put spread. So that put spread is only $1 wide. So this is where the skew is in our iron condor. It's skewed to the bottom side, meaning that we have less risk to the lower side of this iron condor because it has a more narrow strike selection and the bottom side on the puts. We still took in an overall credit of about 35 cents for each of these iron condors that we sold, so we took in a pretty decent credit overall. So here's a chart of FXE. You can see the currency is definitely under a lot of pressure, coming down and selling really hard. And again, implied volatility has now started to spike up from where it was earlier in this month. And so now it's at about the 78th percentile, which is very high implied volatility, which kind of really allows us to go ahead and sell this iron condor and FXE. But again, what we're trying to do here with the skew is just minimize the risk that FXE does continue to move lower. We want to kind of reduce that side of the trade and cut that potential loss if FXE falls. So what we actually did, just kind of logistically, we went in, again, sold the $2 wide call spread above the market. So you can see this is where our positions are. We sold the 109s, bought the 111s, so $2 wide. And then down below the market, we only sold the 201, 101 put spread below the market. So only a $1 wide spread below the market. And you can see now on the risk profile that this is the iron condor that we have. And again, you can see the skew that's created to the bottom side here because we only have a $1 wide strike. So we are taking more risk to the top side of this trade. And so if FXE does continue to move higher or reverses and moves much higher than 109 or 110, we do take in more risk to that side. But again, right now, with everything that we're seeing, the technicals and the way the market's trading, we think that most of the risk is to the downside in this trade. So that's why we want to kind of protect ourselves on this end of the trade. So looking at this trade overall, we could make about $105 if it lands inside of our range, about between 102 and 109. Outside of 102 or below that, we could lose about $195. And if it does happen to go up before any adjustments, because we would obviously make adjustments to this trade, we could lose about $495 to the top side of this trade. So it's a very clean, very good looking skewed iron condor. Really good case study for us to look at here tonight. As always, if you have any comments or questions, please add them right below. And until next time, happy trading.